All right, I guess we'll go ahead and get started. Not a huge crowd today. But the classic album of the week is Rubber Soul. This is a Beatles album, and the Beatles had all sorts of different styles. I was never a big Beatles fan. I was much more a Rolling Stones fan because the Rolling Stones are much more Chicago blues. I don't know if you follow any of the old rock and roll history, but actually a lot of the Chicago blues was exported to England, and then it came back with the Stones and Jimi Hendrix, and so a bunch of bands from England were sort of redoing the Chicago blues sounds. But anyway, this was an album where they went sort of folk, and I did like that one. Norwegian Wood is on here. I've Just Seen a Face. Run for Your Life. There's a bunch of good little tunes on here. So Michelle. So anyway, you might want to take a listen to Rubber Soul. Like I said, is one of the Beatles albums that I found interesting. Another thing is that go ahead and look in the corporate income tax subfolder that's in your folder for the ECON 402. There's a number of articles in there. Things that, again, for your paper, sort of repeating what the paper's supposed to be. I mean, the paper's just supposed to be 8 to 10 pages on any topic that you find interesting that deals with public finance. So that could be on the corporate income tax if you wanted. You could do it on the individual income tax. You could do it on debt financing, anything that we've covered. But the idea is for you to tell me why I should read your paper, why you found this interesting. Like a couple pages saying, for example, President Biden, I don't know if you're following this, but he is proposing an increase in the corporate income tax rate. We talked about the 2017 Act, moving it from 35% down to 21%, and then he's talking about moving it back up to 28%. Okay, so you might say, well, this is what I found interesting, and then a few pages on that I know you've read something about it, right? You've read articles, sort of in a sense, a literature search. But I don't want the paper to just be a literature search. At the end, I would like you to spend a couple pages talking about what your thoughts are, right? So you go, okay, well, this National Bureau of Economic Research paper said this about the corporate income tax, or there was an article in the Wall Street Journal or something about the corporate income tax, whether this was a bad idea or good idea. And I think that raising the corporate income tax rate to 28% is likely to cause this problem, or it's likely to reduce the deficit, and therefore that's going to be a positive or something like that. Okay, so just 3 parts to it. Again, I think you're going to find, this has happened lots of times, right? I've taught the class. But I think you'll find that the 8 to 10 pages is not going to be a problem getting to that length. It may be that it's a problem of keeping it down from, once you get interested in the topic. So again, 3 parts to it. Why this is an interesting topic to you, why this is important, the literature search, so I know that you've read articles on it, and then the third part is that you've thought about it. Okay, so any questions on the paper part, right? Because you're going to be on break for a bit, and if you wanted to get started on that might be something worth doing. And so last time we went through on that the fact that a corporation is a legal entity, and different states are where you form your corporation, and it's under different state laws how you do that. You might be incorporated under the state of Delaware or the state of Michigan, and that we talked about some issues about corporate income tax, and that for example, we talked about if by not allowing the corporation to deduct dividend payments out, but you allow them to deduct interest. That might have a bias towards deficit financing. So we talked about things like that. And then we talked about what happened in the Tax Cut and Jobs Act of 2017. Now, in particular, I've included in that, your folder, there's a National Bureau of Economic Report paper, Who Bears the Burden of the Corporate Income Tax? Okay, is it on cap? We've sort of been talking about that the corporate income tax is likely to be a tax on capital. Okay, but this NBER paper is rather lengthy. Again, if you find this of something that you might want to write your paper on, this is a good paper to take a look at. Another thing is there's an article in there called 2020 Corporate Tax Rates Around the World. Okay, so again, we talked about the fact the jobs cut actually reduced our corporate income tax rate to about what the level of the OECD countries are, right? It didn't take us from, about the middle to really low. And so this has an interesting list of all countries, top 20 countries in terms of highest rates, top 20 in terms of lowest rates, et cetera. Again, we mentioned that Ireland is one of the countries that has a low rate. And then there's a summary of the 2017 corporate tax change. Okay, so you might want to go ahead and look at that. It's a few pages, but it goes through and tells you we've already talked about it, but in terms of your understanding it better, or terms of your maybe studying for the final or whatever, that might be something to take a look at. And as I mentioned, Joe Biden just came out with a suggestion, or that part of what his program is going to be to raise the corporate income tax back to 28%. Right? We noted that it brought it down to a flat 21% rate, and it'll be interesting to see how that moves through the House and Senate. And obviously the Senate is tied 50-50, and whether they'll try to formulate this thing as a reconciliation bill where they can avoid the filibuster. There'll be a whole interesting sort of politics to follow as over the break. It'll be interesting to watch how that works. All right, let's just take a little bit of look at the theory of taxation, and the question is, what would happen if it was a tax, if the corporate tax, if the corporate tax was on economic profit, right? So if you remember back to, we talked about this before, but if you remember back to your Principles of Micro class or the ECON 105 class, we talked about economic profit. What is that? That's the profit that you've made above the opportunity cost of the resources, right? Because we talk about firms in a competitive market, what happens? They make zero economic profit. Well, then the question is, well, why in the world are they there if they're not making any profit? Well, they're making profit. They're making an accounting profit, but it's no more than what those resources could earn somewhere else. Because if firms are making economic profit, what will happen? That says that they're making more with those resources in whatever that industry is than they could somewhere else. So what's going to happen? Other people are going to say, well, holy smokes, Bullwinkle, why don't we start doing that too, right? Because we're making zero economic profit over here, and they're making more than the opportunity cost over here. Let's go over there, right? So when they enter, shifts the supply curve to the right, prices fall, output increases, firms will continue to enter until economic profit goes to zero. So what if all you did was you taxed economic profit? Well, again, we can take this is figure 15.1 if you look at in your textbook, figure 15.1. And what happens here? You have an average total cost curve that looks like that, right? And you remember that the marginal cost intersects the average total cost at its minimum. Okay? Now, suppose that you have a competitive firm so that demand equals marginal revenue here. Okay? So now what will happen is they'll go to where? They're always going to go to where marginal cost equals marginal revenue. If you're maximizing profit, you're going to go to where marginal cost equals marginal revenue. And so this is quantity here, and this is price over here. This is Q star, so that's where they'll be producing, right? Marginal cost equals marginal revenue. Now, but what is profit? Profit is, right, it's price minus average total cost times quantity. Right? It's your economic profit here is the difference between the price and the average total cost times the quantity. So total revenue is price times quantity. Average total cost times quantity is total cost. So total revenue is going to be bigger than total cost. So if we did that, then we'd notice that if we took this rectangle A, B, C, D, that rectangle A, B, C, D is going to be economic profit. Okay. So we got the rectangle A, B, C, D. That's economic profit. Suppose that we tax that. Okay. Now, what's going to be the economic effect of taxing economic profit? Notice that what happens to marginal cost, right? Marginal cost doesn't change, right? Marginal revenue doesn't change. So by taxing the economic profit, I'm not affecting your marginal cost, okay? I'm not affecting your marginal revenue. So what's going to happen? Q is going to stay the same. So what does that mean? It means that there's there'll be no effect in terms of the amount of output that's out there, right? It's not going to change price and quantity. So if I were to tax economic profit, that if what happened is the corporate income tax, if all it did was tax economic profit, then it wouldn't have any effect on total output. It wouldn't have any effect on the price and quantity. So notice also that it doesn't matter that I drew the demand curve as a straight line, right? Because you're going to get the same thing. If I had a downward sloping demand curve, they use the example of monopoly in the book, but anybody's demand curve that's downward sloping, so the same thing's going to happen. Oops, let me go ahead and. Okay, so if I have P and Q, and I do the same thing, I have an average total cost here. I have a marginal cost that goes through here. Suppose that I have a demand curve that's downward sloping. What's the deal? The deal is that your marginal revenue is down here, right? Marginal revenue is going to be less than the demand curve, right? Because to sell another unit, I get that unit, the dollar amount from selling that unit, but I got to sell other units at a lower price, right, to move that demand curve. In the demand equals marginal revenue over here, why does it go along there? Because I can sell all I want at the same price. That's the story of a perfectly competitive firm, right? But if your demand curve is downward sloping, what's going to happen? Your marginal revenue curve is going to be there. But notice also that where do you go? You go to where marginal revenue equals marginal cost, okay? And if you go to where marginal revenue equals marginal cost, right, the price is here. And notice that the average total cost at that point is down here, okay? And so you get the same idea, right? That is, if we go A, B, C, D, right? that rectangle again is going to be your economic profit. So you get the same idea. Economic profit, what is that? It's where the price minus average total cost times quantity, right? And so what's going to happen here? I don't change, again, no change in the marginal cost, right? No change in marginal revenue, so you'll still have the same price and quantity that you did before. So it doesn't matter that you drew I started out with a demand curve that was perfectly elastic, right? If that demand curve is downward sloping, it's an oligopoly, or it doesn't have to be a monopoly, but any time that to sell more units at a lower price, you're going to have that marginal revenue curve, which is lower than the demand curve. But you still get the same point, right? You go to a marginal cost equals marginal revenue. And marginal cost and marginal revenue don't change when you tax the economic profit. And that economic profit then again is the price minus the average total cost times we'll put this times Q star here. That is what your economic profit is, okay? So if the tax is on economic profit, then if the corporate income tax were a tax on economic profit, then it wouldn't affect output. But the tax isn't just on economic profit, right? Because the owner is supplying capital. There's an opportunity cost to the capital that's being used, so that right? So the tax does not allow a deduction for the opportunity cost of capital. So that means that in fact the owner of capital is going to be bearing the burden of the tax. Now, can I shift my stock of capital, right? I've got a factory, and I'm having to pay the corporate income tax. I'm not allowed to deduct the opportunity cost of the capital that I've got there. So in the short run, if you sort of think about it, in the short run, the stock of capital for an individual firm is fixed, right? That is, in the very short run, if you imposed a corporate, let's say the Biden corporate income tax passes, and it increases the corporate income tax from 21% to 28%. Okay, in the short run, you can't do anything about that. You can't say, oh, I'm gonna invest less. What I'm gonna do is I'm gonna reduce the size of my factory, or I'm going to use fewer robots, or I'm going to use less machinery, right? So in the short run, the stock of capital is fixed, and so what happens is there's the owner of the capital bears the burden, right? Because it's basically a fixed cost, right? The opportunity cost of what I've spent on the factory or on my computer system or whatever it is, that's stuck for right now. And so if we think about that, then the tax, the burden of the tax is falling on the owners of the capital, and P and Q doesn't change because it's a fixed cost, right? So P and Q doesn't change. Now, in the long run, though, if we think about the long run, then there will be an effect. That is, in the long run, I can my machinery, et cetera, is depreciating, right? It's wearing out over time. I could just not replace it, right? Or I could eventually I could close down that factory, and I could not have as many factories in the long run. Okay? So in the very short run, if Biden raises the corporate income tax to 28%, in the short run, that's going to be basically a fixed cost to most companies. But in the long run, Amazon may have fewer distribution centers, right? General Motors may, in the long run, produce fewer cars and so have, fewer car production facilities. Okay, so again, this is like a fixed cost in the short run, but certainly firms can respond. And how long is that time? Well, that sort of depends on what the technology production is, right? It may be that you can respond more quickly today than they could in 1953 or something like that, right? So it just really depends. It's an empirical question about how long that time period might be where it wouldn't affect price and quantity. All right. Now let's think about the fact that we're only taxing the return to capital in the corporate sector, right? Because it's a corporate income tax. It's only C corporations that are paying it. We talked about the fact that if you were an LLC or if you were an S corporation or you're a partnership, right? Those are pass-through entities. So that the profits that are made by a law firm, that partners, the law firms are generally set up under partnerships, Bernstein, First Family of Law in Michigan, I've watched their ads, but anyway, if you take a look at how they're taxed, the partnership will fill out a form March 15th, but it'll say to the IRS, here's how much the partnership made, and here's who the partners are, and here's their share of the company. And so the IRS then knows that, if they made $1 million and you had 10% of the partnership, you got your $100,000, the IRS knows that's supposed to show up on your personal income tax, right? But under the C corporation, those things are entities, right? We said that they can enter into contracts, they can hire people, they're basically a person, and the corporate, they pay under the corporate income tax. So you've got this distinction between the corporate sector and the non-corporate sector. And that distinction is discussed and has been discussed for a while. And the question is, this fact that I'm taxing one sector but not the other sector, what's going to happen? And this is a famous model, and this is often called the, I don't know why these things aren't working this well. As soon as my hip gets fully fixed, I'm going to go back to the blackboard, right? This irritates me. These things work this way. Okay, this is the Harburger model. Okay, let me try that. It's called the Harburger model because in 1962, that one works. 1962, Harburger wrote a paper in the Journal of Political Economy, one of the major journals. He wrote a paper in the Journal of Political Economy discussing this movement that will happen if you have a corporate income tax, this movement that will happen from the corporate sector to the non-corporate sector. And just intuitively is that if it turns out that this is primarily a tax on the return to capital, which is what we've basically argued, that it's generally a tax on the return to capital. What will happen is there'll be a movement of basically loanable funds or investment will be moving from the corporate sector to the non-corporate sector, right? Because you get this tax over here in the corporate sector, but you don't have it in the non-corporate sector. And so that movement is what Harburger develops in his theory. And so the focus on the Harburger model is this movement of loanable funds and this movement of investment from the corporate sector to the non-corporate sector, which, makes some sense. If what's going to happen is I'm going to tax the return to capital in the corporate sector, people are going to go, wow, I can get more return in the non-corporate sector because it's not taxed. So what will happen is funds will flow from the corporate to the non-corporate sector. So the Harburger model assumes basically four things. And the first thing is that the overall supply of loanable funds is, so we'll just put, these are assumptions. Ooh, I wonder if it works this way. I was just looking if I was doing the angle wrong on this thing or not. Okay, so the first assumption is that the supply of loanable funds is fixed. So the overall supply of loanable funds, if we, and what happens to these loanable funds? They get invested. The deal is, why are you borrowing money? You're borrowing money to build a factory, right? You're borrowing money to buy robots. You're borrowing money in order to increase the amount of capital, right? Which is investment, right? Remember that investment to an economist is not you going out and buying shares of GameStop or something like that, right? Investment to an economist is what? It's an increase in the stock of capital, okay? So if we think about this, then what am I doing if I look at the supply of loanable funds? We're assuming that it's fixed. If we drew a little Rod Stewart picture for that, it says if we put the interest rate here, and if what we do is we put total investment here, we have a supply of loanable funds, and what happens to those loanable funds, right? What happens is you are supplying money to people to do what? To go out and invest, right? So if we look at the supply of loanable funds is that way, and now we have a demand for loanable funds. Okay, and what is that demand for loanable funds? It's the return to investment, right? It's the return to investment. So what it does is it says, okay, if we again, what do we always assume, right? Diminishing marginal product, that kind of thing, right? So we assume that the first dollar of investment is going to give you a larger return than the millionth dollar of investment, right? Or the first $1,000 of investment is going to give you more return than the $1,001 of investment, right? So if you have diminishing marginal product of capital, you'll get that, you'll get that story, okay? So what will happen is that the return to investment is declining as investment increases. So, and what is the demand for borrowing, the demand for these loanable funds? The demand for these loanable funds is I'm going to borrow at 3% interest if I can get 5% interest on my new investment, okay? So what ought to happen is you'll keep doing things until the marginal benefit equals marginal cost. So I'll keep borrowing until at the margin, what's going to happen? The interest rate that I'm paying is just equal to the rate of return that I'm getting from the investment. So, so again, funds, sort of be clear about this, is that the funds are borrowed to invest. And invest is what? It's an increase in the stock of capital. Okay? So, again, if you, I believe this is, I forget, this is figure 15A. If you look at the, in the textbook, figure 15A if you want to look at it in the textbook. So a second thing is that it assumes that the corporate income tax is a tax on capital. So that was the first assumption. Assumption number 2 is that the corporate income tax is a tax on the return to capital. Okay? And so this tax on the return to capital, what's going to happen? We're going to notice that if I'm going to get a tax on the return to capital in the corporate sector, but not on the non-corporate sector. So again, what's going to happen? Funds are going to flow from the corporate sector to the non-corporate sector. Third thing is that it assumes competitive markets. So the third assumption is the competitive markets. And the fourth thing is that there are 2 sectors to the economy. And that would be the corporate and the non-corporate. And you can see why he makes these assumptions here, because what he wants to do is he wants to talk about the fact that funds are going to flow from the corporate sector to the non-corporate sector. And that's going to affect the amount of investment that's in the 2 sectors. Okay? So he's making these other assumptions sort of ceteris paribus, right? And empirically, there's a question about how much of or how competitive are the industries, and is this a tax on the return to capital? And as I mentioned, that NBER paper talks about empirical analyses and theoretical analyses of of this model, saying that the Harburger model has been the one that everybody's been using for a long period of time, and maybe things have, again, maybe it fit better in the 1960s than it does in the 2020s, right? It's 60 years later. And so at any point, still, you should be familiar with this model because it's the one that is, from a public finance perspective, if you've taken a class in public finance, you should be familiar with this Harburger model. All right. Again, if we go back and look at this figure 15A, the idea is that the total amount investment, this is going to be, we'll call it investment in the capital plus investment in the in the corporate sector and investment in the non-corporate sector. Right? So if we look at this, then we have that total investment is what? Investment in the corporate sector, which we're calling IC, plus investment in the non-corporate sector, calling it IN. So the total amount of investment, notice if that supply curve for loanable funds is perfectly inelastic, you're always going to get the same amount of investment, right? So what's he trying to do? He's trying to focus on the fact that stuff's going to move from one sector to another. Later on in the chapter, we'll say, well, what happens if the supply curve is not perfectly elastic, or excuse me, perfectly inelastic, right? But for right now, because we're focusing on this movement from one sector to another, we're gonna take a look at that. So what ought to happen is that equilibrium return to investment has got to be the same in both sectors. And sort of think about it. the equilibrium return to investment has to be the same in both sectors. Because if it weren't, what would happen? Well, you just move from one from the sector where the return was greater, and so that when we're looking at equilibrium, what's got to be happening? That is, the return to investment's got to be the same in the corporate sector rather than the non-corporate sector. If there weren't, right? If not, then what ought to happen is that funds ought to move to the sector with the higher return. So in equilibrium, we've got the total amount of investment, corporate sector, non-corporate sector, and what ought to happen then is that if the return to investment is greater in the corporate sector, what ought to happen? People will notice that and they'll move funds over to the corporate sector. If the return's greater in the non-corporate sector, what happens? Funds move over there, right? And then what happens? If you have an increase in the amount of investment in one sector, the marginal return is going to be going down, right? Because we said that you have diminishing marginal product of capital or whatever, that you have a downward sloping demand curve, which is saying that that as I add investment to one sector, the return to capital in that sector is going to be declining relative to the other sector where I've got less investment going on. And so if I have less investment, then what ought to happen is that the return ought to be greater. All right, let's look at, I think we'll just do one more point here, is if we look at figure 15b, you know what? Now I have a theory that what's going on is that if you somehow the air, if you have this one open for a while, the air somehow makes that change. I don't know. I'm going to test that theory. All right. So now if we look at figure 15b, notice that, so what we have is we have the return to investment. We have the return to investment up here, and we have we have a marginal social cost of investing, and we have a marginal social return to investing. That's sort of that's sort of the key to understanding this, is that if we look at this, and what is this? This is the marginal social return to investment, okay? So this is marginal social return to investment in the corporate sector. And what does that say? That says that this is what the additional return that you can get from another unit of capital, right, in that corporate sector. And again, we make that downward sloping because we assume that the marginal return to another unit of capital is smaller as the stock of capital gets larger, okay? So now what we have is the marginal social cost, of investment in the corporate sector. Now here's the trick, and we'll put this as this is the amount of corporate investment here. Okay, so what is the trick? This marginal social cost, we assume that the supply of loanable funds, the amount of money out there that's going to be lent out for investment, right? We assume that's fixed. So what does that mean? It means that what's the opportunity cost of investing in the corporate sector. It's what you could have got in the non-corporate sector, right? So, I mean, that's a trick here to sort of, I don't know, if you know, when you read this section in the book, you know, that's sort of something that to keep in mind. What is he going? What are the authors doing when they're drawing these demand and supply curves? Essentially, we have the demand curve is the marginal social rate of return for capital in the corporate sector. But what else could I have been doing with that? If I take money from the and put it in the corporate sector, what's going to happen? I'm giving up money in the non-corporate sector. So what is this thing? This is the marginal social return in the non-corporate sector, right? It's the opportunity cost. Because I've got a fixed supply of the loanable funds that I've got out there for investing, right? That is for new capital. So what is the cost of allocating those funds into the corporate sector? Well, the benefit is the marginal social return that I'm going to get, right? But what's the cost? The cost is I could have put those funds, because the supply of funds is fixed, right? I could have put those funds in the non-corporate sector. So what is my cost? My cost is, this marginal social cost is whatever I could have been getting in the non-corporate sector. And so if we think about this, then you can sort of think of this as you can think of that as the supply of loanable funds into the corporate sector. But the point is, and this is the major point of focus, is that what this marginal social cost of investment in the corporate sector is whatever I could have been getting in the non-corporate sector, right? It's the marginal social return there, because I've got this. I can either allocate the funds in the corporate or the non-corporate. I can't like not allocate less because I drew the supply curve perfectly inelastic. Okay. So what would happen is this is going to be what the equilibrium return to investment is going to be. Okay. Well, how do I label that? I'll call that R. We'll call that the return, and I'll call that Ri. Okay. Now, what ought to happen is that when the marginal social cost is equal to the marginal social return, that ought to be an equilibrium, right? So Ri and this will be investment in the corporate sector. Okay. Notice that there again the equilibrium is going to be where the marginal social cost of capital is equal to the marginal social return of capital in the corporate or in new capital investment in that sector. So that ought to be the equilibrium return on investment in the corporate sector, and this is the amount of investment going on in the corporate sector. Notice that if you had a point that was up here, like suppose that you had some, we'll call that, I don't know, R prime or something like that, okay? What would that tell you, right? If you are at a point which is above Ri, then what's going to happen? The marginal social return in the corporate sector is less than the marginal social return in the non-corporate sector, right? Because what is this marginal social cost? It's the marginal social return in the non-corporate sector. So if you had a point above Ri, what would be going on? You'd have that the marginal social return in the corporate sector would be less than the marginal social return in the non-corporate sector, okay? So that can't be an equilibrium, right? Because I'd go, well, why am I investing over here in the non-corporate or in the corporate sector? I could be getting more in the non-corporate sector. So what ought to happen is that these things ought to, where the marginal social return in the corporate sector equals the marginal social return in the non-corporate sector, that's an equilibrium. Points above that, which is, if the investment in the corporate sector were over here, then that, wouldn't make sense, okay? Because people would start moving funds around. All right, so why don't we go ahead and close for here. Any questions on what we've been doing? Yes. Well, I mean, I was just making the point that is, it's like anything else where I have a demand and supply curve and I have like a price above equilibrium. What's going to happen? Quantity demanded is going to be less than quantity supplied, so that can't be an equilibrium. Same story here, that is if I pick a point, if I said, oh, what if we were here? What if we had a return on investment that was here and so we were at some point over here, so the investment in the corporate sector were down here. What would that tell you? It would tell me if we were at this point, right, and rather than this equilibrium point, if we were, this is sort of the equivalent of, I drew a demand and supply curve and I picked the price that was above equilibrium. That can't be an equilibrium because what's happened, instead of saying the demand is less than the supply, which you did in a regular demand and supply curve, what's going to happen here is it's going to say, the marginal social return on investment is less in the corporate sector than the non-corporate sector, so that can't, right? So that can't be an equilibrium. What's going to happen is it's going to move this direction, right? So we'll end up down here, right? So it's just basically a similar story that says that if I'm not at where they intersect one another, something's out of whack. And so what ought to happen is that it ought to move towards that equilibrium position. Okay, that makes sense? All right. Okay, well, you guys have a good Easter. We will be working through, there's a possibility that I'll get the exams back on Wednesday when you get back. Like I said, I always try to get them back within a week, but I'm not exactly sure how that's going to work out. But then what we'll be doing is we'll be moving through the corporate income tax piece. Okay?